Good morning, everyone. Welcome to this update for global stocks and commodities for the 4th of August. As I said last week, the big event for the week just gone was the Fed decision on rate cuts, but more importantly, the commentary that they put around that. And certainly the Fed managed to do what they normally do, and that's provide some degree of volatility in the market. So the Fed did cut rates in the end as expected, only by 0.25%, but I guess anyone that was expecting more than that was probably being unrealistic. But it was really the commentary that Powell put around that, which indicated that, look, maybe this might be a one and done rate cut, or maybe there might only be another one, and that's it. And that clearly disappointed the market in the short term, or at least caused the computer algorithms to react as they did. And there was a little bit of a sell-off last week, but probably most of it was around Trump's decision to then come in on top of that the day after and threaten China with more tariffs. So we've still got this situation in the market where it's unlikely to fall very far because it's really the nowhere else to go syndrome. Interest rates are so low that really that's pushed stock value or theoretical stock values up a great deal. So it's unlikely that markets are going to fall too far, but they're going to be quite volatile. And when you get overbought, as the S&P was prior to the Fed announcement, then it's very susceptible to anything at all that can start a little bit of a sell-off. So on the surface, markets are disappointed, but we're entering a period of typical weakness, seasonal weakness. So it was probably always going to happen. So the short-term action, hard to predict, and then Trump does what he does best and throws a cracker in the locker room. So it's interesting times, that's for sure. We'll have a look at the normal stock and commodity trend update. And Portfolio Analyst last week, there was a lot of good member questions that I addressed. I also did an overview of some pretty exciting high growth companies in the Australian water treatment sector, and also looked from a big picture perspective at the risks that we face today, particularly with the way that central bank policy is. Now, turning to America, the S&P fell every day last week, was down 94 points, or a total of 3.1% for the week. As I said earlier, markets were overbought. They were just looking for, they were a balloon looking for a pin to prick the bit of the short-term bubble. Trump obliged, and we just continue this unpredictable and ridiculous short-term obsession with where interest rates are going, when earnings are the real game. And whilst earnings are pretty modest because in terms of growth, because we're coming back from 2018, which saw massive rises in profitability, something like 25% on average, due to the tax cuts. So earnings in 2019 were never going to be startling as a consequence of that. But look, the US consumer, which is 70% of their GDP, is strong. Their data is strong. The consumer sentiment surveys are strong, and that's having a big influence on holding the US economy together. We're approaching a seasonally weak period for stocks, so I think it's unrealistic to expect new highs in the S&P. It's going to be hard work for the next month or two. So as long as you recognise that and you just play the game accordingly, you demand a bigger dip before you enter. You take profits perhaps a little more readily, and just generally be a little bit more patient and play the game a little bit more cautiously. Europe is very weak at the moment. Certainly things aren't good there, and despite what the ECB has done for the last decade, we've got Germany borderline recession. We've got France similarly. Italy, I think, is already in recession. and it's generally pretty weak throughout the Eurozone. China appears stable. So they're the three pillars of the global economy. So the US's economy is sort of doing okay. Europe's in trouble. Japan is just limping along, and China appears stable. So it's a very mixed bag, and markets don't quite know what to do with that at the moment. The US dollar finished flat on the week, but there was plenty of volatility in between. So let's take a look at where the S&P went. So first of all, let's put it in perspective on a monthly chart. So you can see not actually very much at the index level. Some individual stock sectors sold off by quite a bit more. Semiconductors, stocks that do quite a bit of business with China, they sold off. But at the index level, not too bad. Zeroing in onto the daily, down each of the 5 days, most of them not all that large. Wednesday and Thursday were around the Fed decision. But look, this is just pretty normal pullback from being overbought, and particularly at this time of year. So I think it's highly likely, and I'm not into predictions, but this is just a bit of an educated guess based on the whole big picture, both fundamentally and technically, and the time of the year. I think it's likely we're going to see something that looks maybe like this. We're going to get a trading range. I don't know whether it'll go down 3% or 5% or 8%. Doesn't really matter that much. That, I think, is going to be where we are for the next 6 to 8 weeks. And to expect the market just to rebound to new highs. I mean, if it does, it would be a bit of a concern, because it's getting to the point now where the market does need a bit more of a consolidation before it can advance again. Sorry, let me just go back. I just want to touch on the US dollar. So the US dollar didn't change much in the end. It was very, very slightly higher, but you can see spent most of the week significantly higher until we got the Fed decision, and then we sold down, which is, I guess, normal. The market was expecting something different from what they got from the Fed, and then of course Trump did his thing as well. So that all caused a lot of volatility in that area. Australian stocks, our dollar fell. It was down at 67.6, I think, from memory. At one stage, rebounded a little bit on Friday to finish at 6,800. But it looks very weak. It's broken down again. And next support is at 67.25. And then if that breaks, then honestly, there's very little support until you get below 60 cents. So it'll be interesting to see what sort of inflationary impact that has on the Australian economy. The ASX 200 fell just a fairly mild 25 points, so it very much underreacted to the US. So it was only down 0.4% for the week. Seems to be a bit of an obsession amongst a lot of people who ask me questions about what the ASX 200 is going to do. I don't burn up too much energy thinking about it, really, and unless you've just got a very broad-based portfolio that reflects the ASX 200, I think it's a fairly meaningless sort of number. I don't see much value in most of the top 100, particularly the older economy kind of stocks, and most of those stocks also lack the earnings per share growth that render the risks worthwhile. So, that's just how I see most of the top 100 in Australia. And I think we're now entering a phase, we're very late in the business cycle and the economic cycle, and I think you really need to steer away very clearly from stocks that have high levels of corporate debt, and that's both in Australia and in America. My view of the market is, if you're not getting a very significant value bargain, so you're buying 20% a year of growth and paying 10 times earnings for it, then you may as well buy the powerful and probable growth stocks that may be fully valued or overvalued, because they'll at least grow into that valuation fairly quickly. Whereas companies that aren't growing very much at the moment, or very slow growth, I think in the economic situation we're in, carry sufficient risk not to make the upside worthwhile. So if you're going to take risk, then let's go for growth, is my view. So we'll just check in. I'll just look at the Australian dollar. So we had a little bit of a shelf here. We've now broken down from that shelf. So there's the breakdown. And our next level is down here at 67.25. So they were lows that were set in December of 2016. So we're certainly getting down to 2.5, 3-year lows. And then below that, there's really nothing until you get down below 60 cents. So you can see clearly the trend is down. The red line, the 200-day moving average is clearly down. The Australian dollar can't get back above it. So there's no question about the trend in the Australian dollar. Now, it's highly likely we'll get a bit of a bounce from 67.20, but the trend is down. It's been down for basically quite a long time, since January of last year. So it's been trending down very strongly for 18 months, and it's really hard to see any change in that. So that's the Australian dollar situation. Turning now to the ASX 200. There's our double top, all-time high. We've finally got back to the highs of 2007, pre the GFC, and we're getting a predictable pullback. But at the moment, we're still getting higher highs and higher lows, which frankly surprises me. But I think all that's happened is that a lot of relatively low growth stocks, large cap low growth stocks in Australia, have had their PE multiples pushed up, and I think that's a little bit dangerous. So that's the ASX 200. Now turning to gold. This is gold on a weekly chart. So let's pan back and look at this in a couple of different time frames. Big picture, gold bottomed out in 2015 at roughly 1,050, and then since then we had a very powerful run for 6 months in 2016, and since then we've been forming this this ascending triangle formation. Really is what it is, with a flat top and higher lows. Now we've finally broken out, which occurred in the middle of June, and we're now heading up. So the top of that ascending triangle was a 38.2% retracement of this whole rundown from 2011 to the bottom. We've then got another level here at 1480, which should be a 50% retracement, and then we go to 1581, which is 61.8% retracement. So those two levels are targets. So it's probably another $30-40 in gold to the upside is a reasonable target, at least in the short term. Looking at this on a daily, you can see that on Wednesday, gold sold off. So when the Fed commentary failed to point to a longer run of interest rate cuts, then the US dollar bounced, which is what you'd expect, and that put gold down. Now, the amount that gold fell was almost exactly the currency effect, so there was no added selling in gold. And then the next day, well, before I go on to the next day, let's just go and look at GDX. So the reaction in GDX, let's put this on a daily. So the reaction in GDX was quite substantial. Let me just take those last couple off. So the reaction in GDX was far beyond what we saw in the gold price. So GDX fell by probably double what I would have expected. And look at the volume. The volume was very, very significant. It was 3 to 4 times what we had been seeing. Now, gold then basically turned around the next day, and that pretty much took GDX with it. So we did get a gap down the next morning. So we closed here on Wednesday night at 26.50. We opened the next morning at 26.10. So gap down, but then just exploded to the upside, and gold turned around as well. Now, the tricky bit comes with responding to this sort of price movement. And I'll come back to this later in this video, but it's really important to have a consistent process. And I think it was more than reasonable to respond to that, because normally that sort of reversal, a big red candle on major volume increase, is a very reliable signal of a reversal. And 80 to 90% of the time, lower prices will prevail, and could be quite a sharp move to the downside. But in this case, it was one of those, I guess, algorithmic head fakes that we get every now and again that makes trading that little bit unpredictable. And the result was that gold immediately and GDX immediately turned around and roared back up again. So let me just go back to the gold price. So there was the response in the gold price on Thursday. So we shot right back up again, and then basically held those gains on Friday. Now, it was a very messy week because we had the Fed, we had some unexpected commentary from the Fed, and then we got some unexpected Trump as well. So it's just one of those really volatile weeks that sent the algorithms a bit crazy. So just to summarize quickly, gold 1441 was the finish. The trend is up in all time frames beyond a day. And of course, with the Australian dollar falling, that took out the Australian dollar gold price up to 21.19. So no wonder the Australian gold stocks are doing as well as they are. So that's really just a bit of a summary of what I've already explained. Turning to other commodities, copper dropped from over 270 down to 257, which it's really struggling under the combined impact of a higher US dollar and a quite subdued global outlook. Crude oil was roughly steady, maybe fell just a little bit, got down to 55.7, but it was quite a big roller coaster week. Spot copper, there's our spot copper chart, fell below $2.60, and there's crude oil. Okay, so just to wrap it up, it's really important, and I know that a lot of people out there pay more attention to fundamentals than they do to technical chart patterns, but technical chart patterns are just so important. And I think these days, when markets are diving all over the place and we've got all of these cross currents and negative concerns that are out there, I think you've got to be responsive to technical patterns, because otherwise you could be caught out in a fairly significant way. As I said earlier, sometimes the algorithms just come along and they trip you up, but that doesn't mean that you should abandon some sort of consistent process, because it's consistent process that that will stand you in good stead through most occasions. So that's really an absolutely vital aspect. Portfolio Analyst upcoming, just continued focus on the high growth Australian small caps, because that's where the action is, and that's where the positive results are coming from, at least as far as my group is concerned. And of course, other established growth stocks as well. There are some other mid caps in Australia that are got market caps in the $3 to $5, $6 billion area that is still offer quite a good alternative as well. So that's it for this week. There's my contact details for any non-members, and I'll be back with you next week. Cheers.